we can see that the Qs are looking particularly bearish too. We've got this triangle setup, which is definitely going to close by the end of this Friday. So what we would expect to see is for the Qs to bounce up one more time before coming through bottom and breaking the downside. If we do hit Hello everybody, my name is Drew Demon and I am the Devil's Stockbroker. In this video I'm going to be doing a quick update on the SPY and the broader market. We just had our Demons meeting this Sunday, and after doing some very thorough analysis on the market, we're feeling quite confident that this last move here at the end of the week, this past week, was distinctively a bull trap. So we've been watching the market form up this big ascending wedge, right? And it's been setting up this way it's taken about a little over 3 weeks for us to get to this point. We finally had this breakthrough after a fake out breakout to the downside here on the 23rd of March, and then we finally got the breakout right at the very end on that same day. So we had the initial drop, and then we had a second drop after that rebound. Now, uh, on Friday, we had a big pop that saw the market trying to recapture that previous support, but failed to do so. Now, the entire market is now trading below all of its previous range of resistance. And at the moment, the bulls are kind of basing on this idea that we've already reclaimed support, when in actuality we kind of are trading within this entire range of resistance here between about 393 and 396 on the SPY. Now I want to highlight something else that was characteristic of a couple of different bear markets that you'll probably find pretty shocking. So I'm going to actually zoom in here and just focus on the SPY. As a matter of fact, I'm going to go ahead and switch over to the SPX. This chart takes us back a little bit further. You notice I've charted this pretty similarly. The only real difference between SPX and the SPY is that SPY is an ETF, whereas the SPX is the index of the top 500 largest companies in the United States economy. So the difference is pretty, minuscule. It's really by definition of what investment vehicles are used on these particular on the index versus the ETF, but they are priced very similarly. Now, the SPX shows that we were trading in this big megaphone pattern, right? And one of the things that we have been watching for was for us to retest this area of support. This has been the lowest point in the market, right? And we hit this in mid-October 2022. This was on the news of uh, a big reversal in the CPI. Everybody was really excited because it showed that inflation was slowing, and the market rebounded with hopes of a Fed pivot that did not come, but nevertheless, we saw enough bullishness in the market to bring us back from the brink of disaster, and the market rebounded. Now, ever since that point, we've been trading in this zone of ascending support. Here is the problem. This is identical to many other very similar setups in the market that we have seen before. And I'm going to wipe away a lot of this chart just to call out a couple of things. We're going to follow this trend right here. Focus just on these tops of this market. We're going to also focus on the bottoms here with this one cutting down through it, but we can see there's bottoms all of this area of support. So this is a big channel, right? Big bullish channel with a big breakout expected right here. And this is what everyone's talking about, right? Well, unfortunately, this is exactly the same fake out setup that we have seen before. First, I'm going to switch this over to the weekly chart so that we can see this a lot more clearly. So you can see that we've got the bottoms of these wicks on these candles still in the same place. We're just switching this over to a daily chart. We have this one breakout, right, with this support area showing a bounce off of the outside of the channel, right? Okay, I'm going to take you back in time. This is the years 2006 through 2008. If you weren't around in the market at the time, this is right when we had the great financial crisis, starting with the subprime mortgage crisis that occurred in July of 2007 that resulted in an initial scare. And then finally, in October of '07, we saw the peak of the market and the market started to drop. And then over the course of the next 2 years, we saw the market starting to drop out pretty harshly. Now, one of the things that had occurred in the market that everyone was super, super excited about was this breakout that occurred in May of 2008, April, May 2008. That seems pretty familiar because this is the spring season. Prepare for a summer rally. The market moved ahead of this move, expecting the summer rally to carry market back to the upside. The problem is that precisely at this moment, as we were peaking in this market, we were experiencing something unprecedented in the financial sector. There's two ways that we can compare this to our current situation now. One of the obvious ways is to go and compare what the stocks of various banks were doing at the time. Let's go ahead and take care of the darling of the United States Fed and take a look at JP Morgan Chase. As you can see here on this chart, we look at JP Morgan Chase. We started to see that the banks experienced some pretty severe liquidity problems right around the time that we were peaking in the market on the last week of April and the first week of May. And right at this moment, JP Morgan was getting affected by a contagion effect that was sweeping some of the other regional banks in the market as a result of the housing crisis that was occurring. This was the aftershocks of what was called the subprime crash. And as I mentioned, the subprime crash occurred back in July of 2007. This date is very important because in July of 2007, we were experiencing a mass wave of defaults of subprime lending that was occurring in the housing market. And this affected everybody that was below a certain income level that couldn't qualify for traditional mortgages. So they went to subprime lenders. And these were primarily financed through regional banks that had partnership with these subprime lenders. Now, things are a little bit different these days because now subprime lending is a lot more, shall we say, monitored and regulated. But nevertheless, the effects of the liquidity issues hitting these regional banks is what eventually spelled disaster for these bank stocks. So JP Morgan is only just one of these banks. Let's go ahead and take a look at a different one that you'll be able to compare more like apples to apples. Let's take a look at Bank of America. So Bank of America experienced some of the worst of it. Bank of America actually saw some of the worst liquidity issues after it was announced that they were absorbing some banks that were having a handful of struggles that spring. So a few regional banks were being absorbed by Bank of America, and the contagion effect was starting to affect them a lot worse because Bank of America also financed a lot of subprime lenders. This really got out of hand when Bank of America announced that they were buying out Morgan Stanley. And then it was found out later that Morgan Stanley took some massive losses in the mortgage backed securities market. And because of this, Morgan Stanley actually had one of the most famously disastrous trades in the market as a result of writing its own credit default swaps on mortgage bonds that it had created, not realizing that the mortgage bonds that they were writing were actually not properly rated, and they should have been rated in the B double B or triple B standard, and they were actually rated as double A and triple A, and these bonds failed when the mortgage market collapsed. This kind of contagion effect was sweeping all these major banks and hitting all the regional banks. And as you can see, there was this one other technical pattern that you may have noticed cropped up here was that as the market was starting to show a little bit of relief and we broke through this descending line of resistance that we can see on the weekly chart here, You can also take note that there was also this very similar megaphone pattern. We broke through the top of this megaphone, and all of a sudden, market dropped out. Once the liquidity issues were known, we got rejected by the 200 weekly moving average and then capitulation. And this massive wave struck the market all at once. Let's go even further back in time. Let's go back to the 1970s. This was a fun time. This is the Volcker era. So in the 1970s, we saw that the market was showing a lot of strength, lots and lots of strength coming back out of the Fed's decision to start giving some much needed reality check to the market in the wake of a big inflation problem. Now, when those rate hikes struck, the market reasonably pulled back. And then early on, this was before Volcker, the Fed chair at the time was pretty eager to create some relief after banks started to have some struggles. And this created a bit of a euphoric bounce in the market. The banks that were undergoing some pretty serious problems with being able to lend to clients or customers that were unable to qualify because of the massive lack of job opportunities in the market and the rampant inflation that was starting to sweep the economy at the time. And then once banks started to have their own struggles, suddenly there was this big dropout. And notice that it was characterized by this breakout of a, guessed it, megaphone. This megaphone that we have seen in the market in 2008 and again here in the early 1970s. And as the market was recovering, it saw a bit of bullish momentum. There was talk about the Fed cutting rates, which they ultimately did cut rates, but they didn't do it until the following year. And unfortunately, they did it early, and the inflation came back more aggressively. So we've already learned this lesson, but for the purposes of this chart, inflation isn't really the important bit now. It's that when we saw the market got a little bit over exuberant and we saw everybody jumping the gun early, they got hit with a dose of reality and the market capitulated. We, in fact, crashed even lower in the following year. How about the dot-com era? This is one that doesn't get a lot of attention. The dot-com bust also had a very similar setup. You look at this megaphone pattern that was showing up, and yeah, we had a really bad crash in the tech sector a couple of times. We actually set up some pretty historic drops with how quickly this market came down on a couple of given weeks. And everyone finally thought it was all over once we had had this one last little capitulation wave. The market had set its third new low, and then it came back and bounced with a vengeance. And after setting up a triple top formation outside of this megaphone, there was one final blow that hit the market when finally the banks started to have some serious liquidity issues because of their lending to different high risk growth tech companies. When all these tech companies finally finished collapsing, the real collapse of all those tech companies that took place earlier in 2000 and 2001 finally hit the banks the end of March and May of 2002. And then by this time, that was when the liquidity issues forced a whole bunch of banks out of business. And we saw the market finally hit its lowest low point. So now we're going to bring it back to the SPY as it currently is right now, or rather the S&P index. And as you can see, we've had this bull channel or megaphone pattern that we have been mapping out for a good long while. And after all this time, we have had this really bullish looking breakout that everybody has been super excited about. Everyone's talking about how this is the end of the bear market and that the Fed is going to pivot. Well, the Fed's not pivoting. That entire thesis was crushed by Jerome Powell in the latest Fed speech when he addressed the market following the Fed minute notes being released. And at the moment that he said at the closing comments of the Q&A section that there is no rate cut in our base case, that was when the market should have known and become fully aware. And in fact, it did when it completely pulled the rug on everybody. And we saw the market drop out for the remainder of that trading day. When that news finally kind of washed over the market like ice cold bucket of water. We can imagine that everybody else has been looking at Jerome Powell like he's to blame for this somehow. And while I could say that the decision to cut rates as much as they did early on in 2020 in response to the COVID crisis, as well as printing all these dollars and giving out cheap cash to these corporations, was ultimately what caused inflation. Their decision now to raise rates and get inflation under control is ultimately the correct one. And that's not because it's going to force the market to crash. The market crashing is a natural consequence of this. What it's really doing is it is preventing the massive expense of inflation getting out of control. And this is going to create, if inflation does get out of control, it will create an expense for every American. It doesn't matter where you are in your income level, it doesn't matter where you live, it's going to attack everybody. Inflation is like an invisible tax that strikes everybody at the same time, and it creates this invisible expense on us that we don't feel, we only see at the cash register, but we're never really truly prepared for it. And the problem that all of these other stupid correspondents and all these LARPers on Wall Street just chiming up and begging the Fed to cut rates and to pivot early are literally begging for the American economy to collapse, because if they do this, it's going to cause inflation to get insanely out of control, insanely quickly. And when that happens, it's going to be so much harder to tame in the future and force us to go through a whole lot more pain. Now, the banks are going through their own liquidity issues, right? And we know that it's because depositors are pulling funds. As I have discussed in my previous video, past week when I talked about the Fed chopping up the market, is not because the Fed is raising rates. It is because inflation is out of control and it's causing a massive expense for average Americans. So, as far as the technicals go for the market right now, this is what I am looking at. This is how I am trading accordingly. So here we are, a few minutes after close on March 27th. I apologize I didn't get to finish the video yesterday that I was filming, but all the better, because now that we have this confirmation move here today on the SPY, I feel a lot more confident in the analysis that I was already starting on. So I didn't actually make any trades during the day today, but I did enter one position right at the end of the day before we close. And we're going to go over the technicals on the SPY as we go through that. So the first technical pattern that we have been watching for a while is this ascending wedge. Ascending wedges are notably bearish. They are relatively accurate in their targeting, that you tend to see a rejection off of the top of this wedge after usually the third or fourth attempt to break out the top, and then you get a rejection and get pushed down through the bottom. And that's how you trade ascending wedges. And you can see that after the first target was met, we got a big bounce off of this. Now we have a second pattern that has developed out of this. So we're actually going to go ahead and remove this. We're going to get rid of our ascending wedge because now that has been confirmed, and we are going to focus instead on this new pattern that has developed in the form of this head and shoulders. So we have our first shoulder here, have our head here. We have reached our new bottom, which is the neckline, and we have hit a top on this shoulder here at about 398.81. Now the anticipated move from the market is for us to retest 390 and then break through to the downside. You can measure this by taking a support line and draw it along the bottom wicks of the neckline. And the first trade that I have started today was on this three-line strike. You can see that we've got these very large wicks on these green candles as we're moving to the upside. We actually gapped up today by a pretty significant margin. We wicked up 1, 2, 3, 4 hours straight and created these really indecisive doji candles the whole way up. And then we confirmed a large engulfing red candle to the downside, which engulfed the last three, actually all four of these green candles. This is what's known as a bearish three-line strike, and this candlestick pattern has been known to be extremely effective at triggering a reversal move. And we can also detect that we've had some pretty stiff resistance here at 398 because we have these tall wicks on these three sets of candles. We have one right here. We have another few right here. And of course, we have these very tall wicks on the head of our head and shoulders. So technicals show us that on the 1 hour chart, things are looking extremely bearish. And as we were going through this setup on this trade, I actually took a short position on the SPY at around 396.50. And our target is the neckline because we do expect to have to retest this at some point. So my take profit for that will be just over 391. And I'm anticipating taking profit on that before Friday. The other setup that we have here is that we do have a MACD crossover that is pending. This hasn't actually completed yet, but it is looking like it is about to. The 3-line strike, however, is enough of a confluence for me to be confident in my trade for a move to the downside. But that is not all. In the closing hour of the day today, we were looking at large flow on unusual whales. And this is courtesy of the unusual whales bot that we have in the Discord. And we looked at the big flow for all of the contracts that were traded with a premium higher than $250,000. And as you'll note on the SPY specifically, all of these contracts were greater than $250,000. And you can look at these pairings here. Most of the large trades are trading on the ask side, and there are a few bid trades here, but you'll notice that a lot of these bid trades pair up with the same timestamps as the ask side trades. So this cluster of 5 trades right here were all made at the same time, and you'll notice that the ask trades are at higher strikes than the bid trades, which indicate that this is a spread of some kind. This is a bearish put spread, which is used to hedge the position and cap maximum gain, as well as set a maximum loss, offsetting the price of the overall contract. There was also another set of trades down here, a lot of ask side trades here for a premium of over 46 and $36 million at $465 and $450 strike mid-June. So these are massive, massive floor trades, as you can see, that were done on the exchange here for the SPY. And this indicates some overwhelming bearish flow from institutions. If we go over to the Qs, then the flow you'll also see is just as bearish. We did get a surprising call contract, which was showing a very large no side trade, which we would call this a mid trade. This is usually just a cross exchange trade, so this one doesn't really mean anything. The puts, however, are pretty much all on the ask side. All the very far away trades are on the ask side. We've got some spreads here as well, and we have some very large put spreads down here expiring mid-June, all the way down at 300. So you've got a lot of in-the-money put contracts being exchanged here for excess of $500,000 to over $1 million. The largest of these trades was an ask side trade for April 21st expiration with a contract strike of $360 on the Qs. So when you compare all of these contracts, let's go ahead and take a look at the Qs. This is mostly tech sector stuff. We can see that the Qs are looking particularly bearish too. We've got this triangle setup, which is definitely going to close by the end of this Friday. So what we would expect to see is for the Qs to bounce up one more time before coming through bottom and breaking the downside. If we do end up getting that completion of this descending triangle, then the anticipated move would be for us to retest 303, and probably, given that this is overall a large double top, we have a top here and a top here, our most likely outcome is that we'll see the Qs retesting around 395 by the middle of April. It's more than enough time for the Qs to take a huge nosedive in that time. And you can look at any of the most recent moves on the Qs or any large tech sector stocks. We'll actually go take a look at the heat map right now. And you can see that Apple, Google, Meta, Oracle, Adobe, Netflix, Nvidia, they're all making large moves on a weekly time frame. We had our very first move to the downside, however, on the daily. So the Qs have finally showed their first sign of weakness across the entire sector. All of these tech stocks getting pushed back down and getting rejected from these new highs is a signal of potential divergence. If we go back over to the SPY and the HYG today, then you can see that we had some divergence that I marked out here for the Discord. The HYG engulfed to the downside. That's this blue and yellow chart right here. So this engulfing move to the downside on HYG shows that this gap up that we had on the SPY is not being agreed with by the bond traders. And as a matter of fact, what you actually end up with here on the SPY is an orphan candle or an abandoned baby candle. You have one green candle up to the upside and then a gap up candle that is left by itself. And the wicks and the body do not intersect with the body of the previous candle. So this is the definition of an abandoned baby candle. Pretty much the same setup as this gravestone here. Also, this was also an abandoned baby candle. Technically more like an evening star since the wicks here on the next day intersected a bit, but still very bearish setup. So this is pretty much working for us as confirmation, and we can see that the ratio chart shows that we are getting stalled out here at 5.40 on the ratio chart. That is a clear sign of resistance and hesitation in the market. And given that we already have had a top here on the ratio chart in this location, this exact place, it's kind of acting like a ceiling. And this is why I use these ratio charts for dividing SPY by the HYG, because it shows this invisible resistance that people are not looking for. No one expects there to be this lowering line of resistance based on what bond traders are doing. But when you look at the ratio chart by itself, it becomes a lot more visible to you. The next thing that I want to take a look at is the dollar index chart. This has also shown a lot of bullishness. The drop to the downside that was triggered by the Fed stepping in and backstopping all the banks created this island. This is actually a bullish island pattern that shows up many times in the markets, and it only lasts for a few days. You get a big gap down, and then you have some chop down in the lower, this trading zone here, this range. And then once you get your breakout, you would actually take a long position right here because this is the breakout where it enters the gap. You go long here, and inevitably it breaks through the top and closes that gap. Now that the dollar index has done this, it's actually re-entered into this descending wedge. This descending wedge, I have been waiting for a breakout because it's actually part of a larger cup and handle. Now, technically speaking, this has invalidated the cup and handle because the handle it's got too long of a tail, so this cup and handle is no longer valid. However, we do have a situation where we see that we are bouncing off of a very clear level of support. The dollar index, if we do see this, catch this area of support here, which has been established by these wicks on this double bottom pattern right here, then you will see the dollar index attempt to break out of this descending wedge. And if it does succeed, we would anticipate the dollar index to shoot back through its previous trading zone. So once it breaks this resistance, our target would become the top at 105 and 40 cents. That translates directly into an extremely bearish move in stocks because every time we've seen the dollar index shoot up that quickly, we always see a retreat in the stock market. So that is what we are anticipating. The next thing to take a look at here would be the bond market. Today we saw a huge surge in bonds, which triggered a large retreat in the market, I feel. The 2-year bond was somewhat signaling this when we attempted to break through the 200 daily simple moving average. And we now see that the 2-year bond yields are starting to hold up there. The 10-year bond, however, is moving at a much greater pace and is already breaking through. If it ends up breaking through this resistance here that you see is marked by these two wicks here, then we might actually see bond yields skyrocketing all the way back up to their 3.9% target. If that were to happen and it were to outpace the 2-year bonds, then what we would actually see is the yield curve would be exiting inversion. If this line is reached, then this is signaling that a major crash in the stock market is only just around the corner. This is exactly what I was talking about when I was explaining the false breakout of megaphone patterns in the previous crashes that we've seen with major market black swan events. The 2008 Great Financial Crisis, the dot-com bust, the 1970s twin crashes that were caused by stagflation. All of these were demarcated by these same moves. And now that we have completed the day, we can actually very clearly see that this false breakout is just forming out a head and shoulders, which, if it does end up breaking to the downside this week, will line up exactly with all of those previous crashes that we just got done analyzing. All this is to say is that everybody needs to be extraordinarily careful this week. The market is not recovering like everybody has been hoping for. Bulls have been pushing this narrative that a Fed pivot is going to come just around the corner, and when that failed, they tried to claim that the banking sector is still intact. I just received information that Fed Barr, in his testimony today, announced that he believes that the situations with the banks that led to the liquidity crisis of both Signature Bank and Silicon Valley was a systemic issue. Him just saying that says everything that we need to know about what sentiment is like at the Fed and at the higher level in Congress, and this is going to lead to panic. Once this information starts circling around and everybody becomes fully aware, and by the time you even see this video, it is likely that it's already reached everyone's ears. It's very likely that we're going to see panic sweep the market in the following week. So I want to caution everybody against getting too euphoric, getting too hopeful about a market recovery. Hedge yourselves accordingly and do what you have to do to protect yourself. That's going to be it for this video. I want to thank you so much for watching, and I will see you in the next one. Until then, have a hell of a time in the markets. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more. And if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.